Good morning. My name is Sushant. I am here to speak about the operating leverages. First, the meaning of leverage. Leverage is an investment strategy of using borrowed money, especially the use of various financial instrument or borrowed capital to increase the potential return of an investment. It refers to the debt or to borrowing funds to finance the purchase of inventory, equipment, and other companies' asset. Leverage is used to describe the ability of a firm to use the fixed cost asset or funds to increase the return to the equity shareholders. So it means the basic objective of financial management is a wealth maximization, means maximize the wealth of equity shareholders. So here the leverage is used to describe the ability of a firm to use the fixed cost asset or funds to increase the return to the equity shareholders. And leverage can also refer to the amount of debt a firm uses to finance assets. In financial circles, trading on equity and leverages are used interchangeably. Leverage is the benefits that accrues to the equity shareholders in the form of higher earning per share. That means the maximize wealth of equity shareholders. So there are three types of leverage. First one is operating leverage. Second one is financial leverage. And third one is the combined leverage. But here I am going to explain only operating leverage. The meaning of operating leverage is operating leverage is the measure of combination of fixed cost and variable cost in a company's cost structure. Operating leverage refers to the magnified effect on the operating profit, that is EBIT, earning before interest and tax, for a given change in the sales due to the presence of fixed cost. So first, what is the meaning of fixed cost? So fixed cost which represent manufacturing overhead, office and administration overhead, selling and distribution overheads remain unchanged even when output increase or decrease. Variable overheads like material cost and labor cost vary proportionately with output. In short, the fixed costs are independent of sales volume. It means it doesn't change, it remains constant. But variable cost change with the sales value. So leverage is one kind of advantage. In business, we have the risk. So what is the meaning of risk? I already told the leverage is one kind of advantage because we don't know the future, means whether company earns profit or not, whether companies earn profit or loss in the future, we don't know. It is uncertainty. It means the uncertainty with respect to earning profit. This uncertainty is called risk. So the reason for that risk is fixed cost. So here the operating risk is measured by the operating leverage. It means how much is operating risk is in our company is measured by the operating leverage. So we have the formula to calculate the operating leverage, that is the contribution divided by EBIT, means earning before interest and tax. So here we have the format to calculate the operating profit. So first, sales less variable cost from sales, we get the contribution. After that we deduct fixed cost from that contribution, we get EBIT, that is the earning before interest and tax. Less interest, we get EBT, means earning before tax. Less tax from EBT, we get EAT, means earning after tax. Finally, we deduct preference dividend from earning after tax. So we get earnings available to equity shareholders. So this is a format. So next we have the problem. Calculate operating leverage when sales rupees 1 lakh units at rupees 10 per units, when variable cost rupees 6 per unit and fixed cost is 2 lakh. First sales, that is 10 lakh rupees, less variable cost from sales 6 lakh, we get the contribution, that is 4 lakh rupees. Less fixed cost from that contribution, we get 2 lakh. Finally, we get EBIT, means operating profit. So, the formula of operating leverage is the contribution divided by EBIT, earning before interest and tax. Here contribution is 4 lakh rupees divided by EBIT is 2 lakh rupees. We get 2. Interpretation is the operating profit will increase twice the percentage of increase in sale. Means a 10% increase in sale will result 20% increase in operating profit. For example, you consider you are a teacher. You have a classroom to teach. The rent for that classroom is rupees 10,000. That is fixed. That doesn't change. That is fixed. That is 10,000 rupees. Suppose you are teaching one student, or if you are teaching 50 student, but your fixed cost means rent is fixed. Rent is same. That is 10,000 rupees. As you are increasing your sale, as you are increasing your student, you will get more benefit. It means EBIT increase rapidly. It means the percentage change in EBIT is more than the percentage change in sale because of the fixed cost remain constant. The fixed cost remains same. It doesn't change. Here the operating profit will increase twice the percentage increase in sale. It means a 10% increase in sale will result in 20% increase in EBIT, that is operating profit, because of fixed cost remains same. So next is the degree of operating leverage. The degree of operating leverage is also called DOL. When two situations are analyzed, the degree of operating leverage is used. When two situations are analyzed, at that time the DOL means the degree of operating leverage is used. We have two formula to calculate the DOL, means the degree of operating leverage. The first one is the Q into P minus V divided by the Q minus V minus F. Here Q is the number of units, the P is the price per unit, the V is the variable cost, and F is the fixed cost. So we have the formula, we have the problem. Here unit sold 10,000, unit price 50 rupees, variable cost is 12 and the fixed cost is 1 lakh rupees. So we get 1.38. It means the sale increased by 10% and change in profit in 13.8%. So this is the DOL, the first formula. The next one is the percentage change in EBIT divided by the percentage change in sale. However, the result is the same as operating leverage of the original situation. So this is the DOL. When two situations are analyzed, at that time the degree of operating leverage is used. The next one is the significance of operating leverage. First is the sales operating profit relation. It means the operating leverage establishes the quantitative relationship between the sales and operating profit. It means the operating leverage establish one kind of relationship between the sales and operating profit. The degree of responsiveness of operating profit to change taking place in the sales is very well identified and established. Here operating leverage establish the relationship between the sales and operating profit. Next is the role of fixed cost. The unchanging behavior of fixed cost for changes in output is very well understood with the help of operating leverage. It also directly measures the relationship between the operating profit and fixed cost. Here, operating leverage helps to identify the role of fixed cost in the company. It helps to identify the position of fixed cost and variable cost in the company. So, operating leverages helps to identify the role of fixed cost. The next is the measurement of operating risk. Operating leverages helps to identify the operating risk in the operation. It means a higher operating leverage indicates a higher level of risk in the operation. So, when we find the risk, we have to take steps immediately to reduce the risk by increasing the sales value. The operating leverages gives an early warning signal to the management. So, this helps to identify the risk and helps to reduce the risk in operation. So, this is the significance of operating leverages. Thank you.